Hello, Sit Room executives. Welcome back to another episode. Spencer Gray is a serial entrepreneur that began flipping houses when he was in high school. Even though music and recording was his primary dream, he always had multifamily on his mind. After starting and selling a successful hops brokering business, he dove in. He co-GP'd his first 132-unit multifamily deal, which taught him many valuable lessons about investing in apartment buildings. He then took that experience and went on to scale up his business to over 8,000 units and is fast approaching $1 billion in assets under management. In this episode, Spencer shares with us some tips for scaling to an 8,000 unit portfolio. Spencer, welcome to the show. Thank you for joining us today.
Hey, thanks, Dion. Appreciate you having me on.
All right. So let's go ahead and give our listeners a little bit of an idea about your background and how you got started in real estate.
Yeah, no, absolutely. My background and the path to how I got here certainly wasn't a straight line by any means. I've been a little bit of a serial entrepreneur. I flipped my first house back in 2006. I was still in high school, did it with a buddy of mine who wanted a partner. Learned a lot of lessons at that project. Eventually went to music school. I wanted to open a recording studio. Was essentially working freelance in recording studios, independent contractor, working for audible.com, a couple media distribution companies, kept flipping houses and had some successes, a lot of failures. Eventually started another business where we were brokering hops for the craft beer industry, from growers out in Washington, Oregon, to craft brewers around the country. Eventually became the largest broker in the Midwest, one of the fastest growing in the U.S. Sold that company and had always been interested in multifamily. Didn't understand everything about it, but understood just instinctively, like I think a lot of other people do, that having more units under one roof, all in one location, the ability to scale that process made a lot of sense. So it was a lot of years of educating myself, networking, and then eventually kind of wrapping the rest of my family involved. I got some friends involved, and started partnering with other groups and surrounded ourselves with people that had more experience than we did, smarter than us, and then kind of piece by piece being able to build a portfolio and kind of grow the group.
So your first rental property, was that a single family, multifamily, or?
Single family. This was about in 2006, so just before the Great Recession. So I was in high school. I had a friend whose father was an attorney. He had been flipping houses, and he went up to his son and said, "Hey, I want to teach you how to do this, but you have to go find a partner." And so some of the lessons on that deal was really just how to deal with a partner, because he, roped me in. We both had to go and, beg our parents for a loan. And then after we kind of started the project, he took off for the summer to go to like a summer camp and said, "All right, well, how about you get the rest of the repairs done? Things are essentially moving, and I'll see you at the end of the summer, and hopefully we'll sell the thing." And so I made about every mistake in the book, and, hired my friends who had no experience, and, paid them more than I was making, because I was making, nothing, just putting sweat equity in. Doing too many of the repairs ourselves. Could have saved a lot of money. Hiring somebody to do a lot of things that we just thought that, we can do this. We'll save a buck here or two, but ended up would have been cheaper hiring it out. And throughout that process, all of a sudden banks stopped lending on single family homes like they had been in the past. And we kind of found ourselves in a position where it was really hard to sell the house all of a sudden. Eventually had converted it to a single family rental and eventually sold it. But honestly, we didn't make any money. It was just more of a learning experience.
Okay.
So that's how I kind of got the first taste of real estate. And if anything, it taught me that, all right, this is something that's possible. This is something I can do. If I'm a high school student and I can figure it out, maybe not be extremely successful, but now I understand the pieces, and I think it can be done in a way that is successful.
So from that experience, and then you went on to following your dreams, in
Yep.
a recording studio. But
Yep.
how did you make that transition? Because you said you always wanted to do something with multifamily, right? But how
Yep.
did you make that transition? And what was your first deal like?
Yeah. So the first multifamily deal.
Yeah.
Yeah. I had flipped a couple more houses after I graduated from college, and I kept looking around, seeing apartments and seeing, it just seems like there's something there. So I started doing some reading, started looking into buying apartments, didn't have the money to do it at the time. And also, and this was back in, I think, 2013 or so, 2013, 2014, things seemed really expensive, and we were still feeling the aftershocks from the Great Recession, and everyone was saying, well, the economy is going to collapse again. And so we didn't feel confident to go out there and just start buying when we didn't know. So we kind of tabled the idea, went and started the hops business. Then we were in the process of selling the hops business. That's when that itch really started coming back, and I was looking for the next thing. And it was really through a process of networking, meeting people who were just already doing it, that we kind of made some of the connections. And because we wanted to do a deal on our own, we said we want to go out there and buy an apartment building. But the more we learned, the more we realized we didn't know, and that there was a lot that we don't know what we don't know. And we didn't want to all of a sudden find ourselves in a situation where we thought we were going to be, maximizing our return by doing it all ourselves, but then we can make a mistake, and really that return would plummet and it wouldn't be worth it. So we actually were introduced to another operator. We were speaking with a lender, and we had heard of HUD financing. We can get 35-year amortization, 35-year terms, low interest rate, non-recourse. And we said, how do we get this financing? He said, well, I'd love to do a deal with you guys, but you don't qualify. You don't have any experience. You don't have the management. But I know this other guy who's done a couple small deals. He's done one HUD deal. He's looking to partner. Why don't you guys get together and see if you can maybe make something work? So we were still hesitant to really partner with someone because, again, we just felt like, why not just do it on our own? And we had conversations for probably over a year with this one operator and syndicator, he wanted us to do his deals, obviously, and we were trying to get just to really pick his brain to see how he had done what he had done. And we were looking at, all right, well, why don't we start small, get a couple doubles, a fourplex, sixplex, whatever we could afford, really. Until eventually we said, well, this deal looks relatively good. And we essentially approached him and said, all right, we'll partner with you, but we want to learn from you. I think I can bring a lot more money to the table just through my network. I had investors, my other businesses, who trusted me throughout that process. And if, we're able to really partner on a deal, I'd be happy to do multiple deals with you. So we ended up partnering. We did a co-GP deal as our first deal. It was about 132 units in Indianapolis, kind of C+ property, needed a ton of work. We thought that we had enough in the budget to do all the repairs necessary. We didn't, because he was still relatively new at this also. He had done a couple 30 units and 50 units. This was his largest deal. And so that's kind of how we started. We partnered with him on that one deal. And now we've done about 10 different co-GP projects together. And I ended up building up an investor group. I started with my family, then went to my friends. I kind of started in addition to Gray Capital, which is my business focused on multifamily and commercial real estate, started a family company, essentially. People started calling it a family office. I'd never heard of the term family office at that time, but it was essentially just kind of pooling my family's capital. My father was an entrepreneur, sold his business, wasn't happy with his current money managers, the fees he was paying, the returns he was getting, was skeptical of public securities in the stock market. And so we said, well, we can create some retirement income, for you. So it'll be very tax efficient, not as correlated to the overall public markets, and we can start building out a company. And so we kind of use that as a bedrock to kind of just grow our base over time, keep doing co-GP deals, also invested just as a limited partner in some projects. And once we kind of built a system and really a platform of multiple operators, a couple different asset classes beyond multifamily, really stepped back and I said, well, what if we rolled this platform out to other investors and other individuals who were trying to achieve what I was trying to achieve, but more specifically, looking at my father's circumstance, and there's a ton of people out there who are nearing retirement or at retirement who aren't happy with most of their net worth being tied up in stocks or in the public markets, who want to diversify to commercial real estate, but just don't know how. And so if we can roll out our platform, our strategy to others and just kind of plug in what we've been doing, we can help a lot of people. And so that's kind of the quick, short summary.
So there are actually a couple of things I wanted to ask you. The first one, you mentioned on the first deal that you guys had missed the mark a little bit on the budget. Yep. Would you be able to tell us a little bit about that? So what exactly happened with that?
Yeah. So it's a story of there was just so much deferred maintenance. The previous owner hadn't really done anything for 15 or 20 years. And, in the business, we can get excited about that because there's a lot of, value to add. But you're also hoping that, it's more cosmetic and not as much, structural and physical. And, we would go in and we were going to repair some plumbing or repair a cabinet, and you'd go in and you'd fix one thing, but then, 10 other things would break around it, and just everything just seemed to be falling apart. The pool had a crack in it, and we had to replace the entire pump system. It seemed all the HVAC units just seemed to be going out one after the other. And no matter how much money we put into it and how much work we did, every time we would go to the property, it still seemed like, we would look around and there was so much wrong with it. And we thought that we were relatively well capitalized in the deal. I think we had about $800,000 for it, budgeted, that we had in reserves to do these repairs. But it taught us a lot of lessons that, honestly, due diligence up front, really making sure we understand what it is that we have to do, and then, leave a healthy contingency in there. And then, we made a lot of mistakes of, hiring the wrong contractors and then bringing it in-house, hiring out contractors again. So it really took a while to really tweak the whole system. And I have to give, credit to my partner, who was really doing a lot of that, being really in the trenches and getting a lot of that done. And the project is performing well now, but there were certainly some bumps in the road. And the positive from that story is taking all of those mistakes and a lot of the figuring out on that value add project. We've never really repeated that circumstances. So all of the other projects we've done, we've either, gone in well capitalized to an appropriate amount, but also just going in on due diligence, we've just been able to either avoid getting into properties that just have, it was real kind of a can of worms situation where you just keep finding problems. I think we've gotten better just identifying those up front, really before we making our offer, and trying to find a better balance of, well, we can still we can spend the certain amount, but we're not going to have to spend over on items that we're not going to be able to see much of a return, maximize our dollars into areas where we're going to actually see a return on those dollars. But that doesn't necessarily mean, because it was an older property, but that doesn't necessarily mean that every older property is going to have the same amount of issues. So it was a lot of lessons learned throughout that process for sure.
And so final follow up. Sorry about that. Follow up
Yeah.
question for this, because you mentioned due diligence, right? So it seems as though the mark was probably missed at due diligence.
Yep.
So do you think, like, was it because there wasn't a system in place? Because this was your first deal of this scale, so maybe you didn't have like a full due diligence system in place, or was it you had the wrong inspector, or like what? I'm just trying to pinpoint like specifically what aspect of that process was it?
Certainly our systems are much more robust than they were then. Just the property management team has grown considerably. And so instead of it just being a couple people walking through, in addition to, your inspections that you're going to get your lender usually requires, now when we do a walk and due diligence, it's, a dozen to almost 24 people. So, we have a full team, a lot of people who are on the maintenance staff, so they know what to look for. And we are much more systematized and going through every unit with a checklist, understanding the condition of every single unit, what it has, what finish level it's been brought to. And also, I think it's just the experience of being realistic. I think on that first deal, we were probably a little overly ambitious to get it done. We thought it was a good deal. The basis was really strong, and we just wanted to get the deal done. I think that led us to overlooking a few things and not to pad the budget in our CapEx reserves for what could really happen. So I think really that it's the more of the mindset and the mentality of, wanting to be focused on getting the deal done, but it needs to be right. And maybe we were going to spend a little bit more money, but if you look at the overall length of the deal, it's the right thing to do. And sure, returns may go down a little bit if you bring a little bit more equity to the deal, but you have to do what's right for the deal itself. So I think that's the biggest takeaway, I think, is really the mindset of how we approach the project.
Okay. So let's kind of hone in on scale here, because I mean, what you've done is really impressive. You have, I believe, what your portfolio is over 700 million in assets under management. I mean, you're really close to $1 billion right now. How do you get to that scale? I mean, you start with one, that 132 units, and then from that point, how do you get to where you are?
The key to our ability to scale has been in our openness and our ability to partner with others, and just the belief that we're going to be able to accomplish a lot more with others than we're going to be able to do on ourselves. And so that's not just from an experience standpoint, which is why we really started. We wanted to hedge our lack of experience with others who had more experience with us, but all of a sudden we have access to so many more opportunities and so many different ways to do deals. Because if we would have just said, we're going to go out and just buy buildings just by ourselves and only limit it to the people that we know and really kind of close it off, we would, I'm sure we would be doing well, but we would be at a fraction where we are today. And so I think by building those relationships with others who were on a high growth trajectory and, honestly, not just one step ahead of where I was and where we were, but they were many steps. And so, I've got several mentors, but, one mentor that we've done a lot of deals with, and he's taught me a lot. His whole team has, he was probably 2 steps ahead of me. And I have another mentor that we've done a lot of deals with, and not only just co-GP deals. We've just done some simple limited partner investments with him because we just trust his ability. He's many leaps ahead of where I was. He was approaching 10,000 units, did a $70 million deal one year, and then, it was $150 million in deals the next year, and he just keeps growing and growing and growing. Being able to see that scale and what it takes to put all those pieces together, it really, it just expanded my belief of what was possible. And to say, we don't have to stop at just doing this. If we just keep putting the right pieces in place and keep doing the same things over and over, repeating what's working, and then just continue to add the systems as we need to, anything's possible. So it was really having the right examples in front of me, and really just kind of putting the teams together and surrounding myself with people who had done it before me.
So what are some of the challenges, I guess, from with throughout this whole process?
Yep.
So, we're talking about, let's say if we just have, a 500 unit operator,
Yep.
At this size, to right now you have over 8,000 units, so
Yep.
what are some of the challenges or systems that are needed that you think are
Yeah.
critical?
Right now, a major challenge that we're facing is that since we have scaled very quickly, we're trying to really play catch up, like on our asset management side. So we're bringing more people onto the team right now to assist with asset management, just because you can grow, but then it's one thing to be doing deals, but we have all of our existing deals, and it's easy. You can't just forget about what you've done in the past, and they don't just run themselves. And even though, we've been able to partner with groups that have property management companies, and so we're able to be a little bit more streamlined, because we don't do any of the property management ourselves. We partner with other groups that have property management companies. No one's going to inspect your investments like you're going to inspect your investments. No one's going to watch your money like you're going to watch your own money. And even though that everyone has skin in the game and everyone is generally moving towards the same goal and moving in the same direction, you never can expect what you don't inspect. And especially when there are assets that are, slightly underperforming or things that you can tweak, that's what keeps me up at night is, what could we be doing differently? What's being missed? And so just a big challenge right now is to make sure we do have eyes on everything that's going on in the portfolio and making sure that nothing's getting missed. And so adding just several additional layers of due diligence and asset management, kind of across the portfolio. That's something that we're working on right now to shore up and just do a better job at.
So you mentioned having more people to,
Yep.
more human power. Okay,
Yep.
try to be gender neutral here, and so like, what else do you find to be kind of necessary to help with that aspect, the asset management aspect here? Because I've heard a few different things from other syndicators in the past, but in your experience, what else do you think, as far as maybe like technology or other systems or?
Yeah, technology is something we're always looking at. Obviously, communication, and so technology is great. Nothing replaces, I think, consistent communication with your partners and with the people you are working with. I find that if you're not in regular communication with your team, that's when things not necessarily go wrong, but things can get lost, and you can be off the same page. And so that's something that always try to focus on, and it's not necessarily new, but just staying in constant contact with your team, our investors, operators, partners. I think that's critical, and that's regardless of what size you are, whether if you haven't started, you have one unit, or if you have, thousands of units. One thing that I've really been just focused on this past year is to be, working more on the business and not as much in the business, and really trying to bring people kind of in who, again, are smarter than I am at a given task. And, specifically asset management, we're bringing some people on that have been working at companies with tens of thousands of units and who've seen, a variety of different styles of assets, and can just bring a little bit of a different edge And honestly, we're bringing them on because, we're hoping that they can bring some of these systems that they've implemented or they've used in their companies, try to bring them over to our firm. And, they say, borrow in music, they borrow or steal from some of the best masterpieces. And so, we're not necessarily trying to, steal anything proprietary, but just trying to use some of the best practices that some of the best firms have established, and then tweaking them for our uses. And one thing in this industry is there's no reason to totally reinvent the wheel. It's a very repeatable process. There are tons of benchmarks out there to look at. And that doesn't mean you can't get incredibly creative and put your own mark on it and do it your own way. But I think the ability to benchmark is powerful, and it's something that we try to do whenever we can.
Now, you mentioned like communicating with your team and your investors. So, what kind of contact do you, or frequency in contact, do you feel is ideal and appropriate, for like your team and then with investors?
Yeah. That's a good question. That's something that specifically with investors, that's something that we kind of wrestle with all the time, because we don't want to bother people too much, but people like to hear from us at the same time, and so it's trying to find that balance. I don't think anybody gets too upset if every other week you're sending them an email, or honestly once a week. I don't think is too much. When it comes to our partners, it's at least, once a week, if not, several times a week, maybe not every day, just because, at some point, you only get so much new traffic through your apartment communities in one day or 1 week. And so if we're talking about, what's changed and what's new, you can end up starting to go over a lot of the same topics and start rehashing. Then it's not necessarily the most effective use of time. But for investors, I think, if you listen to Grant Cardone or some of those guys, there's really no limit. But I think every other week is a healthy amount to stay in touch with your investors. I think even, maybe if you don't have a lot of content, so if you don't want to send them the same things over and over, once a month is fine. But specifically investors, I think they like to know that you're still out there. Things are going well. You don't even have to do a full update, but just, hey, we're still here. Your investment's still working. All is good. And so everyone's different, but I think, as long as it's somewhat regular, everyone tends to be pretty happy.
Now, I know that one other thing, you guys are a bit diversified. So you have multifamily, but you're also invested in like commercial office and, so can you tell us a little bit about that thought process behind that?
Yeah. Right now our portfolio, it's still about 90% multifamily, and then 10%, it's just kind of an alternative bucket. And the majority of that 10% right now is mostly medical office. But we've done some industrial projects, a few commercial office buildings, and through just networking and meeting groups, we found some other opportunities. We aren't big on all the other asset classes, and so the right opportunity with the right operator, can still be interesting to us. Specifically medical office buildings, we think the investment fundamentals and the thesis makes a lot of sense. It's we have an aging population with more healthcare needs. If we can find highly credited physicians or physician practices that'll sign, long-term 10, 15-year triple net leases with rent bumps, and oftentimes the physicians themselves will co-invest in the project itself. We see that just as a really strong asset class. It doesn't get a lot of attention, so the cap rates are a little bit higher, and so it leads to a lot of really great yield and cash flow. So that's something that we've really we were interested in. One of our partners who does apartments, also has a business that does medical office properties. And just over time, just like the apartments, just started learning what he was doing and gained some interest. And eventually we said, the next opportunity, we like to invest some money. And so that was something that the family office side did. We didn't raise external money but so far those investments have been really successful. And, we're looking to do more of them. Still multifamily being as the core asset class. But, again, looking at other real estate companies, and especially the larger real estate groups out there, and you look at REITs, a lot of those groups, very few are really just focused on one asset class. Now, multifamily is the favorite for many groups, but there are still some opportunities out there in other asset classes. And, I wouldn't encourage anyone to just jump into a different asset class, but there's a lot of opportunities there in real estate, and a lot of them exist outside of multifamily. So we'll keep looking for those as they come up, but being pretty selective and surgical when we make those investments.
Okay. What exactly, if you don't mind me asking, what exactly
Yep.
is the play on the medical office?
So it's a long-term cash flowing vehicle, and what we're doing specifically is it's a lot of smaller buildings, anywhere from 4 to 25,000 square feet. I think the largest is about 50,000 square feet, and so on their own, they trade for relatively high cap rates, good cash flow, usually over 9-10% cash on cash. But the idea is over time to amass a large portfolio of all these medical office buildings. And so once we get to scale, we'll essentially aggregate the entire portfolio with the idea of attracting some attention to a larger institutional buyer, like a REIT, to take out the whole portfolio. Now, the big risk in medical office buildings is it can be nice having a long-term triple net lease, but the downside is if you ever do lose a tenant, it can be very expensive TI or tenant improvements, just because doctors' offices are very specific to whatever their practice is. And so to re-tenant a building with a new physician's practice, they'll probably want something completely different. So it can be very expensive to do that build out and bring someone else in. So that's why we like to focus on groups that have high credit rating, or personal guarantees, or a co-investment into the project itself. And then ideally, we like to see them be associated with a hospital, in a hospital network, or at least have some strong affiliations, so we can have a little bit of certainty that they'll be around for that 10, 15-year lease. And luckily they usually are, because doctors, they're very sticky tenants. They don't like moving. Their patients, especially if they're elderly, they don't want to say that they've moved across town or even across the street, because they're dealing with phone calls all day of, oh, I showed up at your old office and I can't find you. So they don't like to move if they don't have to. So it's, and a lot of the advantages that it's just a little bit off of the radar. Not everyone is investing in medical offices, and that lack of interest presents an opportunity for some pretty good cash flow.
So these are not, necessarily like value add type plays, right? There's not much that you need to do to it, or
not necessarily. So, at times there's certainly some work they have to do on the buildings, but for the most part, it's you're going in and it's putting the deal together. Either the tenant's already there, or you're bringing a tenant, right around the time when we're closing the deal. So there's not a lot of value add. It's a lot of it is just where the cap rates on medical office buildings are today, and then obviously how we finance them.
Okay. All right. So what would you say to new people that are looking to get started in real estate?
I think the biggest piece of advice is to really just get out there and start talking to people. I'm sure if anyone's listening, they're already listening to podcasts, they're reading books, and that's certainly step one. But getting out there, going to meetups, getting coffee with a developer or a syndicator, lenders, attorneys, that has, for me, proved to be the most successful and the fastest way to really accelerate the process. I remember feeling when we were very early on, having a couple meetings, and it just gives you the feeling that you're propelling yourself somewhere because you're having a real conversation with someone else who's doing it. And in many ways that it can validate, the beliefs that you kind of feel, but you're not sure of. I've been hearing about this, I've been reading, but it doesn't seem real. But then when you speak to someone who's really doing it and they say, yeah, you can do that. Yeah. Or this is how, that's an interesting idea, but this is actually how it works. I think it really, not only do you get the information and you start building your network, but it all becomes much more real. So if you're interested in multifamily and you're in the process of educating yourself, I'd say get out there and, buy someone a cup of coffee. It's easy to find someone with 20 minutes. I mean, just myself personally, if somebody wants to sit down and talk real estate, I always love to talk real estate. So it's hard for, I don't ever say no if someone wants to get together, and especially if they ask the right questions. So just get out there.
So are there any books that you'd recommend?
Multifamily specifically, or just in general?
It could be anything in general, actually. Something you think would be valuable.
The Never Split the Difference by Chris Voss. Read it for the first time last year, and I listened to it. But it's not a short book, but I immediately had to listen to it again because I'm sure I've missed a few things or two. If anyone hasn't read it, he's a former FBI agent, used to be an FBI negotiator. And it is such an interesting book about human psychology, negotiating, and the way he puts it, tactical empathy. So for anyone, regardless of real estate, I think that's a really interesting book. I'm reading Malcolm Gladwell's new book right now. I think it's called How to Talk to Anybody. It's a little bit different than I thought, but it's pretty fascinating, like his previous books. And Robert Kiyosaki's book that he came out with, I think last year, it's Fake Money. That was if you're a Rich Dad, Poor Dad fan, you like Robert's previous work, it's a pretty solid read, and it's timely. So.
He had another one too, I saw just the other day, I think, that was just released. Who Stole My Pension, I think it is.
Okay.
Did you hear about that?
No, I'll have to look into it, but
okay.
That sounds about right.
Yeah, I just downloaded it on Scribd, so I haven't gotten around to it, but I just downloaded it today. But yeah, I heard that on an interview.
Okay, cool.
Yeah. So how could our listeners get in touch with you if they wanted to connect?
Yeah, sure. You can check out our website. It's graycapitalllc.com. You can also just email me directly, spencer@graycapitalllc.com. I'm also on BiggerPockets, LinkedIn, Facebook. So search for me there. You should be able to find me. But feel free to reach out with any questions. Happy to answer.